All right, all right. Good morning, good morning. How are you guys today? It's so nice to see everybody here already first thing in the morning. We got Jay in the house. We got John in the house. We got Bruce in the house. There's your gold, silver, and bronze. Bruce, you're getting beat. Jay's beating you. John's coming in ahead of you. Bruce is usually number one in here, but he's number three today. All right, we got Albert in here. We got Kirk's. Nice to see you, Kirk. And what do you guys think of the markets today? They've flushed down like a toilet and then popped right back up. Let's come down here to a 1 minute chart just for fun on the S&P and take a look at this thing. So it kind of run down here at our 5 o'clock bell. Look at that. It popped way down, giving us the indication that it was going to be a bearish day. And then it flushed all the way down until the opening bell. And the opening bell, bam, took off like a rocket ship. What do you think of that? What do you think of that? That's crazy. Let's come in here, turn on Heikin-Ashi. Look at that market. Took off right on the opening bell, just like that. How much would that be if we had 100 shares in there? 300, and well, it was about a 66%, 0.66% run. 100 shares would give you $365. Of course, 100 shares would be $55,000. $55,000 in investment went up $365 on the opening bell. If you wanted to day trade that thing. In the stock market. Now, we're not in the futures market where it would have been significantly different. You'd have made your $365 on about $1,000 investment. Pretty cool, right? But we're not in the futures market. We're in the stock market. All right, what are we going to do today? Today, we're going to go look at our portfolio, and you can see we're down quite a bit on a lot of them. The market's just been stagnated since we put these on. We put on a whole bunch of straddles. Or did we put, yeah, we put straddles on. So we put on a whole bunch of straddles, and today we're going to go review those, and we're going to look at the rest of the market and see if we're going to, what we're going to do. All right, so we're going to come in here, and the first thing I'm going to do, this is the S&P 500. We put an iron condor on here. It's not doing anything. We're at $38. Let's review it before we take it off and do some analysis. I'm just going to take it off. But you can see that the two that we sold the call, and the call is up $390. We sold the put at the money, and it's down $104. So on that side, we're actually, the put is not losing as much as the call is making. So that's cool, right? But then we had to buy the insurance policy. So the buy the call is down $440, and the buy the put is up $108. So we're down overall $32. So it's not moving anything. It's just kind of sitting there. And for an iron condor, the way this sits, it's just time decay. And that's what we really wanted to do. We just wanted the market to go sideways. All right. So let's go ahead. Well, do we want to take it off? I was going to say we could take this off and then go do some market analysis on this thing. Well, we don't have to take them off. Let's come in here and hide them. We can just hide all on-screen options. There we go. So are you sure you want to hide your options? Yes, I do. All right. So there we go. So what I want to do is I just want to review our portfolio, and I want to go beyond the Mag 7 today and look out at a couple of other stocks. We've been focused on the Mag 7. I like the Mag 7, but there's other stocks in the stock market, believe it or not. And the reason we like the Mag 7 is because a lot of us right now are trading these yield max funds. And for those of you who are not familiar with the yield max funds, it's only because you haven't been coming to this channel for very long, because we talk about them all the time. All right. I woke up this morning at like 2 o'clock in the morning with this great idea. I must be a school teacher, because I was like, I got this great idea. How can I teach? Because I just came off of a big seminar down in, up in Fayette, Utah. Fayette, Utah. We went to Fayette, Utah to have a seminar. Can you believe that? Well, that was the pheasant ranch, right? And you've heard me talk about the pheasant ranch incessantly because I was trying to get you guys to come with me. A few of you did. It was great to see you guys that came. But those of you who couldn't come missed out on a great time. But we did talk about the yield max funds. And I woke up at 1 o'clock this morning and I had this new epiphany. And of course, this epiphany was, how can I better teach this concept to my students? And I have a new idea. I'm going to work that out, and I'm going to see if I can't get it worked out today and make some new presentations and new ideas on how to teach this concept, because it's kind of a hard concept for people to understand. Once they understand it, it's not hard. Pretty easy once you understand it. But getting the concept across to some people, pretty difficult, and they don't understand the concept. So even in class last night, we had the university class last night. We had some guys that still struggling to understand the concept of the yield max funds, and I spent the period teaching the yield max funds, and they still kind of struggling with it. So I'm trying to think of better ways to give better analogies of how this thing works. And I came up at 1 o'clock in the morning, and then I was so excited about it I couldn't sleep. So I'm kind of tired. Tired because I couldn't sleep, because I was thinking in my head, how am I going to teach this concept to these guys that's still not catching on to how this is working? But I came up with a nice epiphany, and I'm going to work on that for you guys. All right, so I got some new good lessons coming. And there's Chad. It's nice to see you, Chad. Ready to pump some gas with me? All right, so let's go through and let's analyze this S&P 500 a little bit, because everybody's still concerned about this market that's flushing. And if we come down here, I want to always go and refer back to this monthly chart. And this is where I want to start. And the reason I'm very bearish on this market is because of this chart right here. All right. Now, if you remember, this is back in 2020. So this is Corona. And you remember we shut down the entire world. And that's what happened in Corona. All right. So this is shutting down. Right? This is a drawdown right here, back here in 2015. This is the Joe Biden debacle that never hit the news. Nobody even knew it happened, because Joe Biden, nobody ever gave him any crap. So that nobody even realized this happened. But look at the comparison of this to Corona. This is Corona. This is Joe Biden. So the point that I'm trying to make is that we have a big bubble here that's going on. And you guys, some of you have heard me talk about this. And we're just watching this little pullback in here. All right. And so this is making what we call a Fibonacci bow tie. All right. So we measure from the last drop down to the low of the last drop, up to the high, all the way up to here. And then that gives us a Fibonacci projection down the Fibonacci scale. And why is this important? Why is this little thing important? Well, because it's a repeating pattern. And markets have a tendency to do the same thing over and over and over again, even on Corona. So if we come back here, stop that auto scale. So if we come back here to Corona, and we say at the peak of Corona to the bottom of Corona, all the way to the recovery, where did it come back to? 100%, right here. All right. And where was 100%? It was almost exactly to the peak of the previous high. That's called a bow tie. That's our Fibonacci bow tie, from here to here to here to here. Why does that do that? Why does the market do that? Even in times of Corona, it does it. All right. And we're not even in a time of Corona right now. So that is kind of a little bow tie. All right. And you're like, man, that's just a coincidence. Well, it's a coincidence that happens a lot. And if you want to call it a coincidence, I won't tell you that it's not a coincidence. And if you don't want to call it a coincidence, you don't have to call it a coincidence. But nonetheless, markets have a tendency to go through these coincidences. All right. Just a coincidence. But let's trade this coincidence, because it happens a lot. All right. Now that one didn't go perfectly back to the high, but pretty darn close. Look at that little bow tie just right there, just like that. And you can go back and you can do this on all the charts. You can do it everywhere, on Apple, Amazon, Netflix, Google, Caterpillar. You can do it anywhere, and you find this little coincidence. Now, I'm going to tell you it's not a coincidence. All right. This is mathematical models that the big boys use to trade with. And they program these in. And I know it's a surprise to you guys that the big boys don't sit here and click mouses when they trade. BlackRock doesn't sit and have a guy sitting on a desk clicking a mouse when they buy and sell. Is that a surprise to you guys? Is that something new? Did I just teach you something new? BlackRock, one of the biggest brokerage clearing firm, clearinghouse, whatever you want to call them, they're everything. So the biggest brokerage firm in the world doesn't sit there to trade your money when you invest with BlackRock with a mouse, and they don't sit there and have guys on desks clicking mouses to trade. That's not how they do it. Surprise! They use it with computers. They have computers that trade. And what they do is they run algorithms, right? Algorithmic trading. And it's been being done for years and years and years. Clear back, I was in the Chicago Board of Trade. 2000, 2010. That's when I spent my time back there. Between those 10-year period of time, traveling around. I wasn't always at the Board of Trade for 10 years. That's not how I did it. But back and forth, and then working with those people for 10 years at the Board of Trade, and all these great traders from the Board of Trade. And we'd travel around, right? And we'd do seminars and webinars and everything together. And they would teach you how to set up how these algorithms work, right? And they use Fibonacci, Elliott wave, and then of course we try to reverse engineer what they're doing using these mathematical models. And so they play the mathematical model game. And so what we want to do is we want to be able to reverse engineer what they're doing. And if we look at all these coincidences, you can basically reverse engineer their computerized mathematical model trading. Now, I'm going to teach you something that I've taught in the past. So I'm going to keep it short because most of you have heard this. But what they do is they get us to build upside down pyramids, right? And you've heard me say this before, for those of you who have been here, but they want us to build an upside down pyramid. And that's how they take our money, because they have all the money in the world and they can manipulate the markets to do, pretty much what they want. But they want us to build upside down pyramids while they build upside right pyramids. So the big boys like BlackRock, they build upside right pyramids. If I could draw a pyramid with this tool, all right, like that. So that's what they're building. Now, how do they build an upside right pyramid while we as retail traders build upside down pyramids? What we do is we like to buy all the way up an uptrend, right? We buy, the great opportunity, buy. And if you understand the accumulation distribution model of the large hedge funds, that's something that I would recommend you guys go learn. This is dollar cost averaging, right? You guys all heard that term, dollar cost averaging. So when we start to buy all the way up a winning trend, and all of our little indicators down here tell us to buy. It's green, buy, right? Buy. That's what they want us to do. In fact, I bet, well, we know who invented the MACD, and Gerald Appel created that MACD, right? And we should look into his history because he might just be one of these big banks and hedge fund managers. Probably was. I think he was actually. Probably gave us this on purpose. But anyway, all these retail tools tell us to buy all the way up that uptrend. And I think it's a conspiracy theory. And why? Because at the top, you end up with your dollar cost average, all of your ownership. The average price that you bought those shares is up here. And then what they do is they buy all the way down. On the way down, they buy. So they sell all the way up that uptrend. Remember, for every buyer, there's got to be a seller. And so all the way up that uptrend, you are buying. Well, who's selling to you? Well, it's the guys the big boys who were buying all the way down in here. So they bought down in here and they dollar cost averaged on the way down, right? Doing exactly the opposite of what we do on the way up. So they dollar cost average down. So what happens to them? Well, when the market turns around, their average cost is down here because they've been dollar cost averaging all the way down. So they bring their value down. We bring our value up. So what happens is they have a dollar cost average down here. And so when the market starts to rally, which they let happen or they make happen, right? Because they're big, they can do what they want. They have all the money in the world. They can manipulate these markets. So they start the trigger. They pull the trigger and they say, okay, let's line this up with some sort of fundamental activity that can help us boost this market, give us a reason to mark this thing up. And then they mark that market up. And then the market goes and then all the retail traders start to buy and they start to sell to us. All right. Because for every buyer, there's got to be a seller. And if they want to sell out all their positions, they have to have somebody on the other side to buy their positions. So they trick us into buying all of their shares all the way up that trend so that they can sell out all of their shares that they have down here. So by the time the market gets up here, who has no shares? The big banks and hedge funds. They have no shares because they sold them all out all the way up the uptrend, made money all the way up. Who has all the shares? The retail traders. Why? Because we buy all the way up uptrends. So who has all the shares? All of us. We have all the shares. They've tricked us into buying their shares, right? They tell us buy low, sell high, but why don't we do it? Because we need to buy high and dollar cost average in, because we start with one share and up here we're buying 10, 20, 30, 40 because we keep buying more using the profits that we make. And so we dollar cost average in and we continue to snowball that position really high, and we get really excited about that. We think that's the neatest thing since sliced bread. We're rich, rich, rich beyond our wildest dreams. And then what happens? The market only has to move that far and we're underwater. We lose all our money. And all of our money, who does it go to? It goes to these guys. They take it all, but it only has to go that far and we're underwater. Now, that's what they want. They want you to start to sell out. And so they need to get you to sell out. How are they going to get you to sell out? They're going to get you to sell out by forcing the market down. Now, they're not building it up. They're not supporting it. They're pulling their support out, right? So as they pull their support out of these rising markets, the market starts to tumble and fall, and you'll blame it on everything in the world. You'll blame it on tariffs. You'll blame it on Trump. You'll blame it on anything. You'll blame it on everything. You'll blame it on whatever you can blame it on. But really, the fact is, it's just the process of this coincidence. Coincidentally, the market has been tumbling. Why? Because they pulled their support out, because they're out of shares. They don't have any. They're all out. They ran out of shares because they sold them all, sold them high. You bought a whole bunch of shares. Now, they'll sit there and you can get all kinds of justification why this market's coming down. But the fact is, it's coming down so that these big boys can start buying in again. And they want you to sell, but you're stubborn and you won't sell. So they let it fly a little more, but you're still stubborn and you won't sell. So they let it fall a little more, and you're still stubborn and you won't sell, and you won't sell, and you won't sell, and you won't sell. You refuse to sell, so they just let it fall until everybody sells. Once just about everybody's out of that market, who's been buying it all the way down? Because every time you sell, somebody has to buy, right? Every buyer, there's a seller. And everybody's selling out all the way down this trend, and they just keep letting it fall and letting it flush and letting it flush, letting it flush until everybody who's willing to sell has sold. And then what they do, sometimes they play this game. Then they come in here and then they let it go back up. And everybody starts to jump back in. And then they start to laugh and laugh. They think it's so funny. Look, everybody's putting all their money back in. And then what do? They start to sell again. They let it sell. They let it sell, 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 sell. Let it flush, let it flush. Buy everybody who's selling out. Buy everybody who wouldn't sell out before. They kind of trick you one more time to get that thing in there. And then you sell, 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 and they buy, buy, buy. And so they end up all owning all the shares again back down here at a low price, because they've been buying up everything that all the retail sellers have been selling all the way down here. And so now what can they do? Well, they do it all over again. They pop the market and they say, let's do it again. Okay. And they pop the market and everybody jumps back in. Oh, this is my great opportunity to get back in. And so we start to buy all the way up the trend, building another pyramid just like that. And here comes our pyramid, and we start dollar cost averaging back up the trend again. And what do? They're selling out everything they bought down here because they build another pyramid over here, and they have all their positions down here. And that's how they trade. And that's why the market does these coincidences of these Fibonacci projections and retracement levels. All right. That's how they do it. That's how they trade. And they think it's funny and they think it's wonderful. And that's how they do it. And we think it's great and wonderful because we get to buy all the way up these big uptrends, which makes us lose money. Why? Because we're dollar cost averaging the wrong direction. So if you don't learn anything from that, you'll just keep doing that same thing and keep losing money every time the market starts to rally and you get all excited to start buying in. We need to be buying down the way down so that you can buy down, so that your average price is down here. And then if you're going to sell out, you're going to sell out all the way up just like they do. buy low, sell high. The only way you make money is to realize your gains, and so you have to sell them to realize them. You're like, well, man, I'm just going to stay in for the next 22 years. Okay, we'll do that. Just realize you're going to have to sit through the game. All right, you're going to have to just sit through the game because that's how they play the game. And overall, the market will go up. Traditionally speaking, doesn't have to, but it has. Traditionally speaking, it's gone up over time, right? But if you're going to eventually want to retire and take some of your money out, realize what's going on here and how the game is played, and maximize your profit potential and take money out when markets are high. So sell high, buy low. That's the real name of the game. And if you don't, how come that keeps flipping back on? I didn't turn that on. So that's your buy high, sell low process. And you need to start thinking about that when you invest and trade. All right. That's how this game's working. So here, now if I come and get rid of all of my little drawings here and we look back at this thing here, where's it got to go? It doesn't have to go anywhere. It could come down here and just make a little move. It's done that before. This move here compared to Corona, and we thought Corona was a big move, right? See, this was a big move. This was a big move, right? Big pullback. This was a big pullback. Nobody talked about any of these pullbacks in here because the wrong guy was running for president. So we won't mention those. Those are unmentionables. But nonetheless, most people didn't even know that happened, how big that drop was in comparison to the coronavirus. But nobody mentions that because it depends on who's running for president. So now this is a big, nasty drop, right? Oh, tariffs are going to kill us. Oh, everything's going wrong. We're shipping all of our workers out of the country. Oh, we're sending everybody back to, MS-13 needs to stay here to pick the carrots or whatever. I mean, they're going to make up every reason in the world why that thing's fallen. But the fact is, it's falling because the big boys make it fall or let it fall or need it to fall so that they can start to buy in, so they can dollar cost average down, so that they can start to sell out all the way back up again. It's all a manipulated market, and it's all done with computers. And if you think that it's not, you're in the wrong class. I got another YouTube channel for you to go to over there, because he doesn't believe that these markets are manipulated. He thinks that everything's honest in this world. All right, so there we go. That's why I'm very concerned about this market because coincidentally, markets have come back to this region when we've seen this pattern. And does it mean it has to come back that far this time? No, not at all. I mean, there's times where it didn't come back. Even here, Corona, it didn't come all the way back, right? I mean, well, it did on that one. Let's go to find one, see if we can find one that didn't come all the way back. We just did. We found one that didn't come all the way back, right? Like this one here didn't come all the way back to the starting point. So there's your little pattern, and that one didn't come all the way back. See, there's a little distance in there between it. But this is a big move, and I think this is a bubble popping. First of all, the previous administration, as much as we love them and think they were wonderful and marvelous and did such great things, they did spend a lot of money, and that lots of money got put into the market, and it's kind of putting money onto the credit card. So we pretended like we had money that we didn't, and it went into the market. Now, the current administration, these guys we don't like, right? They're terrible because they stopped all that credit card spending. And we like to spend on the credit card. And this guy, he's in there saying, we don't think we should spend on the credit card anymore. That's bad, bad, bad. So when they stop spending on the credit card and it doesn't go into the economy, well, then the market starts to flush back down. And then he wants to pay for it using tariffs. And so they're using that as an excuse to why the market's flushing. All right. So there's all kinds of reasons why this market rallied in the first place, mostly because we put it on the credit card, and then because of AI. AI drove this up too. So we're in two big bubbles. Two big bubbles. Stop spending on the credit card, and AI's kind of, well, it's already here. And is it going to continue? Yeah, it's going to continue. Are these kind of companies make big money off of it? Well, maybe in the future. But this was an AI excitement fueled by spending on the credit card, which everybody likes. I mean, hey, who doesn't want to spend out their credit card? So that's the name of the game, man. And when you stop spending on the credit card, everybody gets pissed off at you. But you know what? Otherwise, we go bankrupt. Which would you prefer? I don't know. It's up to you to decide that, right? So that's where I think this market has a tendency. There's the possibility that we could get this type of a return. And this is why I'm not real too excited about, you know, oh, I don't know. That's what I keep looking at. But then I go down to the 1 minute chart. See, that's the same distance. Look at that. From there to there. Exact same distance. 21% return. Right now, where are we? We're down about 10, 11%. Right? There's another 10% to go if it wants to come all the way back. Doesn't mean it has to come all the way back. It doesn't. And it doesn't mean it can't go further than all the way back. Certainly can do that too. All right. So this is something I keep worrying about. I keep watching this long-term chart because this is how the big boys trade. But then I come down here to the daily charts and I'm like, oh, it's time to buy. You know, we come in here to Microsoft. Oh, it's time to buy. Oh, Meta. Oh, it's time to buy. But really, it's not. Well, this is only an XS X1S A1. That's not a real high probability of a turnaround point. But oftentimes markets will turn around and go back up. Where's it going to do it? We can read the probabilities, X2SA1. Where's this market going to turn and go? There's your A1, B1, C1, X3SA1. This is an X3SA1 down here on Microsoft. We're anticipating, right, a turnaround right here. The possibility this could be the bottom and it could turn around. Well, if that's the case, let's go look at the monthly chart of Microsoft. Come on. So that's the monthly chart of Microsoft. Now, let's turn on Heikin-Ashi, and we're going to come in and do our little mathematical calculation. The little pullback, the rally. Where's it at? It's sitting right here. Where's the top of that? Right here, right there. Is it hit it yet? Not quite, but it doesn't always come all the way back to it. That's just the coincidence, right? Coincidentally, it has a tendency to come back to that previous high. On Microsoft, we're not quite there, but we've got closer than the S&P has. The S&P is just barely breaking at 10% back, right? So if we come in and let's look at what's another one? Let's look at MAGS, because MAGS is all 7 of them combined, right? MAGS is the Magnificent 7. So that's all 7 of the great stocks that we have here on the screen in one ETF. So let's come in here and look at the monthly chart of that. And if we look at the monthly chart of the MAGS, Magnificent 7, whew, this thing's volatile, isn't it? So, we're going to even draw some trend lines on here, right? We got some natural trend lines on here. And then, of course, we're coming in this direction. So it doesn't look very bullish, does it? Doesn't look very bullish. Doesn't mean it can't turn and start to go up. Can at any point. But mathematically speaking, we probably see it come down, test this low here, and bounce and go back up here. Now, it could hit this and come back down one. It could come down here. But we got these blue lights coming in, and we know that the blue lights are kind of the crossover point. See that? If we go back and look in history, they're kind of like mathematically calculated trend lines. So if you draw your natural trend lines, they should match up pretty close with these blue lights. Okay, so where these things turn a little bit slower, they're a little bit deeper, but faster, not quite so deep. But see that? Those blue lights are kind of like mathematically calculated trend lines. So we have this trend line that's coming in here. I drew it across the top, but when you do that, you can see if we anticipate where's it going to cross these blue lights. Well, the trajectory is right down in here somewhere, isn't it? Now, the blue lights are going to come up as the market comes down, so they kind of converge and come together. But it looks like where are they going to meet? Like right in here. So that's bearish for MAGS. Bearish for MAGS on the long-term scale. That's a monthly scale. If we come down to MAGS, let's look at a weekly scale. And we come in and we can do Heikin-Ashi again. Let's draw some trend lines in here. Look where that market's at. Okay, we just try to draw those trend lines and kind of find out where it's respecting these price levels. So we have our progressive trend lines, but you can see that we've got kind of a 3-drive pattern in here off this bottom. It's drive 1, drive 2, drive 3. That's usually our break point. Market likes to go 3 drives. Why? Well, it's a coincidence. And if you believe in coincidences, I thought we didn't believe in coincidences, especially if they're this often, they happen this often. There are no coincidences when you see a pattern that recurs this often. Somebody's doing something, somebody's manipulating something. And I can even name the companies that are doing it: BlackRock, Vanguard, and State Street. All right. They're the 3 biggest firms in the world. They make, y'all think about Goldman Sachs. And you're like, oh, wow, Goldman Sachs, they're big. They make Goldman Sachs look like a toy car. Those guys are so big. They have all the money in the world and they can do whatever they want. All right. So we just have to take that into consideration, that there are no coincidences, right? And if you see these patterns reoccur over and over and over again, somebody's making this happen. And so what you can do is you can look back at all the coincidences and you can make a pattern out of them. You can say, well, every time, not every time, but a lot of time, most of the time when they do this, they'll jack it back up one more time, just like we talked about last time, right? And then they'll let it flush one more time down here. And that's why we have Fibonacci, because we like to measure the delta cone of probability, how far back they generally let that thing flush. And this is where they like to start to buy back in. All right. They like to start to buy back in right down in this region here, so that they can start to dollar cost average in. So they'll let it flush and they have to buy some here to bring the market down, but then they start to buy deeper in here. They go through what they call the accumulation stage. So they want to buy a whole bunch down in this region. This is where they'll start to buy down in here. And you'll see the market jump all over the place and it goes crazy down in here, and up and down, up and down, up and down. Sometimes they'll flush it down. And then we have another number down in here we call the 78.6, right? So if we add that line in there, sometimes they'll flush it all the way down to there, because they like it. If they can get it to go down there, oh, they can buy a lot more down there. We like to buy low, sell high, right? So then they do this, and then we get a market like that, and then they pop it, and then it gives us our little retail trader MACD indicator comes in here, and it gives us a buy signal right in there, and so we all start to buy, right? We start building our upside down pyramid. They've built all their upside right pyramid here, and they start to sell out to us, and that's how it works. And here it is on a weekly chart. Drive 1, drive 2, drive 3, the ABC down the other side goes like this. ABC, we get another drop down in here, and away they go, make money again. And they've got long-term horizons, so they don't have to sit on this. They don't have to make a decision today on the daily chart. They don't have to do that. But smaller hedge funds, they do. You'll get some smaller hedge funds like, Goldman Sachs, for example, right? Maybe some of these smaller firms that like to play, they'll play down here on the smaller, on the daily charts, and they do the same thing. They want to do the same thing. They want to buy low, sell high, so they'll drive the market up, and then they get the little ABC top formation, and then they drive the market down. We get the little ABC down formation. They start to accumulate, and they drive the market back up. They get us retail traders to buy all in, and then away we go. That we buy in, they sell out, they make money, we lose money, and the whole game process runs over again. It's all a cycle. All right. So where are we at here on the mags? Well, we're on X2SA1, which means they've driven it down. We got 2 little drives. All right. We started with the high up here. We got up here, and then that was 3 drives up, 1, 2, 3, and then they flushed it, let it pop up again, and then they flushed it again. Now the question is, are they going to try and start to accumulate down in here and start to drive it up? Have they accumulated enough? Probably not. They probably want a lot more. And then they'll accumulate, and then eventually they'll run it and they'll let it start to go up again so that we can start to buy, so they can start to sell. So that's what's going on right now. They're going through what we call the accumulation stage. All right. This is the accumulation stage. And if you think I made this up, Lynn, you're just blowing shit out your ass. All right. Sorry for the visual. But sometimes you have to say something to rattle you and get you out of your coma. Come on, get out of your coma. Come and look at this. Why cough accumulation, distribution model. Go to images and look at this. You think I made this up? I didn't make this up. Look at this. Wyckoff price cycle. Wyckoff price cycle. Wyckoff price cycle. Wyckoff price cycle. You think I made this shit up? I didn't make this up. I'm just teaching you what I learned 20 years ago at the Board of Trade. Wyckoff price cycle. Wyckoff price cycle. Wyckoff price cycle. Markup, markdown, distribution. That's stockcharts.com. That's one of the largest educational sites on technical analysis in the whole world. They're teaching it to you. Look, accumulation, distribution. You think I made this up? Land's just making shit up again. I didn't make this up. I've learned it and I've traded it. I've traded it for years and years and years and years. Look at this stuff. Oversold, overbought. You've heard these terms. This is where they come from. All right. Greater demand, overbought, supply. It's all in here. This is how it all works. This is how the big boys trade. Wyckoff. There you go. Wyckoff distribution. Look at this. You can just keep going and going and going. It's all here. It's all here. It's all here. It's all here. I didn't make this up. It's how the market works. Everybody who is anybody knows this. All right. Look at this. Just goes and goes and goes and goes and goes. I didn't make this up. I promise you. This is real. This is a real thing that really happens. And real traders and real investors, they know this. All right. This is one of the most important things you can learn. If you don't learn anything else from Mr. Land Turner, this is the one thing you should learn. You should focus every bit of attention you've got, all extra time and money and effort and energy on learning this strategy, because this is how it's done. This is how it's done. Lots of people trying to teach it in many different ways, but the fact of the matter is, this is how the markets are manipulated. This is how the markets are run. This is how they are calculated. And it's a simple process of buy low, sell high, right? Buy low, sell high. All right, that's it. It really is a thing, guys. And so that's why we do that. That's why we look at these markets in this way. And this is why we trade against those numbers, because it's all probabilities. It's not saying that it has to do that. The markets can do anything they want, and those big boys can manipulate it at any time they want. But they're also fighting against each other as well, because as much as they all want to trade the same, they also want to make all the money. They don't want the other guy to make any money. So there's a constant fight between all those big hedge funds. And there's lots more hedge funds than just those three, and they all basically have the same trading strategy. It's just the different sizes that they trade on. So if you go down to smaller stocks, you're going to still have basically the same structure, and it's not going to be manipulated by BlackRock quite so much, but it'll be manipulated by another hedge fund, a smaller one, because it's a smaller market. They all do the same thing. You can go down and trade penny stocks. There's still some guy down there on a penny stock with a little brokerage firm or a little hedge fund that he's going to do this strategy to you. All right. So that's the name of the game. So all we have to do is we have to come down here and look at some of these. Now, I promised that we were going to go look at something other than the MAC. Now, these are all, the reason we're down on some of these is because we've got orders on them. We just put straddles on them all, and we're just waiting for the market to move. The market's been kind of dead the last couple of days. And so our straddles aren't going anywhere. That's why we're down. Tesla's making some money. It's moving a little bit. It's up $500. But that's our straddle on Tesla. So is it time to buy right now? This is an X2SA1. Is it time to buy? A lot of people are buying Tesla right now, and a lot of people are selling out. I saw some great big guy selling out right now, right? I think he's wrong, but that's just me. So this one here's a good one. I like Palantir. I like it because of what it's done, and it's pulled back. It's been beat up in this same drawdown. So we could go through an accumulation stage ourselves. We could start accumulating a little Palantir. Don't throw your don't sell the car, sell the house yet to buy some Palantir. But you want to do a little accumulation, just like they're doing. Buy on the way down, so that you have a dollar cost average down here. That's how you do it. All right, buy. Now, it takes deep pockets to do that, I know. That's why we try to time our entries a little bit better, so that we look at the accumulation stage and the distribution stage of these markets using these indicators. And that's why I use these two indicators. These are my two favorite. The chalk and money flow. This is the one that tells us when they're buying, right? When they're accumulating. So this is the accumulation stage here. That's what the bulls and bears are. They're telling you it's red. So these are accumulation stages. They should correspond with the green chalk and money flow. All right. See that? Now you got the green chalk and money flow, and then the accumulation stage. Now this is PLTR. And if we notice that this down here is the retail trading side of it. So what's happening is you're getting a little accumulation down in here. But when this turns to green, from red to green, that's where we're breaking and starting to go up. But we have to also understand the probabilities, right? So we have to put our probabilities in here, and we have to realize that this is just an X1S A1, which is a low probability. That's a low probability. X1S A1, low probability. I like to, try to give it numbers. Not that it's going to be perfect, but it's about 25% chance that that's going to go up from there. And it's failed. And it came down. So that was exactly what we expect. 25%. That's not that great. So it's 25%, and it's an X1S A1, and it failed. And it's failed. It's okay. They fail. That's what they do. So it failed. How do you know it failed? Well, because it come down and broke the blue lights, and we got a new blue light. As soon as it breaks that blue light, that's a failure. Should have stayed above the blue lights. As soon as it breaks the blue lights, it's a failure. So let's get rid of all this stuff, get it out of the way, and say, where do we expect this market to go now? Well, look down here. Looks like everything's turning and starting to go into the overbought region, right? So it's coming down out of there and starting to turn. Probably going to come back down a little bit. Probably going to come back down a little bit here. How far is it going to come down? Well, we don't know. But we would assume from the coincidences that we've seen in the past that it's going to come down here. And coincidentally, markets have a tendency to come back down into the Fibonacci sweet spot, right? So if we draw the delta cone of probability, and we're going to start it right here and see where that's at. Well, the delta cone of probability on this particular chart looks like to be right around in here. So it may not drop all the way down into this region here. We do have this moving average here, which is I think that's the 200. Yeah, that's the 200 moving average. The markets like to pull back to 200 moving averages when they make these drawdowns. So they draw down, come down to 200 moving average. That's where they'll turn around and start to go back up. And they start making lower highs and lower lows. That's the downtrend. Higher highs and higher lows. That's the uptrend. And so that ends up with what we call a head and shoulders formation. So that would be your left shoulder. That's your neckline. That would be the head. That would be the right shoulder. This would be the right shoulder. That would be the neckline. And then that would be your natural trend line that's coming down across those trends, right? So that would be your trend line. So that's why we say, well, if it crosses above that natural trend line, that's changed from bearish to bullish, and we'd anticipate a rise in price. That's called a head and shoulders formation. Now, if the market comes down and it doesn't do this and it continues down and breaks a new low right here, well, we have to grab the whole head and shoulders system and we have to move it to the next level, right? We have to move that next one down to this becomes the left shoulder. This becomes the new head because it's lower. And then we anticipate the right shoulder, which is higher than the head. And we'd have to say, well, now the market, we're going to look for it to break and go out here. So that's how that works. We don't know how far down it's going to go, but traditionally speaking, when we have a nice 3-drive pattern and we're in a normal market, we generally get a 2-drive pattern down, and it comes down into the accumulation stage, which is right around the delta cone of probability, or what I call the Fibonacci sweet spot. And then that's where the market likes to do an accumulation. That's where it starts to go sideways. You'll see that a lot. That's the accumulation stage. And then they can drop it out the bottom of the accumulation stage and break a new low. And they do that sometimes just to get everybody to give them all their shares one more time. And then they will run it back up. We call that a Wyckoff spring. All right. So you can look into that as well. and then that's where they take the market and run it back up again. So that's your process of manipulation. And that's where we're at in Palantir. Palantir is a strong stock. People don't want to sell it out, right? So that is, you have to realize, oh, that is an X1 SA1. And sometimes we get an X1 SA1 will come down, it'll be shallow, come down, break the blue lights, and then it'll go through maybe a little accumulation stage and then take off up in here. That's not uncommon either. That's a coincidence that occurs on occasion. It's not as common as the other one, but it is common to see a little sideways pattern in here like this. And this market could just go through an accumulation here, and then they could take it off. They're going to build up a whole bunch of positions and they'll start selling out to us retail traders, trying to get us to start to buy in up here. Because this market, a lot of people just want to hang on to it. They don't want to sell. It's a strong market. People like it. Just got put into the S&P 500, and it's got a bright future. So people, they don't want to sell this one. So keep in mind Palantir. I like Palantir. I think this morning I bought $10,000 worth of Palantir this morning. So just dollar cost averaging a little bit in as I get it from my dividends. So I had some dividends sitting on the sideline, so I wanted to roll it in. So I think I put a little bit, and I put it into the Palantir growth. I didn't put it into because I'm dollar cost averaging too on the way down. I want to start putting a little in here in anticipation of a turnaround. I'll put some more in, I'll put some more in, I'll put some more in as it comes into me. But right now I put a little bit in there just to dollar cost average down and see if I can't start to build a position. And then what I like to do is if I'll get some nice growth out of this, we get this thing to shoot back up in here. I'll sell it up in here, take my profits and roll it into PLTY and start taking dividends out of it. So a lot of times we talk about putting our money into PLTY, right? And then taking the dividends. Well, where do you get the money to go into PLTY? Well, I use the profits from a trade like this. So if it goes up and I make a bunch of money, I sell high and then put it into the PLTY and start taking dividends out of it. So that's a nice strategy too. So let's come over and look at, I'm going to come into Land's Richie Rich Fund, and we're going to go away from the Magnificent Seven for a second, and we're going to look at some different markets. So this is ABBV. These are some high dividend stocks that are popular, very popular stocks. And this one here is ABBV. So it's on a nice run. See, A1, A2. We called that the A2. It's not a A2. We thought it might be. A2 came way. Ooh, this market's really done well. Oh, it's getting affected. This is a daily chart too. It's a 3 times a charm. Charm 1, charm 2, charm 3. It broke on charm 3 on that accumulation stage. So this is a nice accumulation stage in here where they're loading up on shares. Buy, not let it run, right? Buy, sell, buy, sell, buy, sell, buy, sell. Keep this thing going sideways so that they can buy a whole bunch and then they can run it. And now what's happening here, all the retail traders come in and they see this thing going, right? So this is all the accumulation stage down here. This is where they all bought in, and then they start selling out all the way up this trend. And so they're selling out while everybody else is buying in. Now it's starting to flush with this other move in the market. The question is, that's an A2. Is it going to stay above here, or is it going to turn and become bearish? So here's our low point. There's our blue line. I'm going to call this our A2 right here. And it just broke it. It broke it right there, and that's why we got the blue light here. So if it stays above there, this would be the next stage of the next rally. They're going to do some more accumulation in here, try to see if people will sell them some of their shares that came up here, get you guys to sell them all your shares down in here, and then they'll run it one more time and try and get it to go up and get another one of these runs. All right, so that's where we come in here with our coincidence tool. What's the coincidence? Well, the coincidence is the Fibonacci rally out of here, ABC. Coincidentally, it has a chance to come back up into this region here. And that would be your Fibonacci bow tie. So it's going to tie that off. It comes down here, here, up to here, back to the bow tie. Let's use this tool. Then you'd come back to the bow tie, which would be back in here, and tie that baby off in here somewhere. right? So if this market breaks on this A2 and they can get you guys to buy in, get all of us retail traders to buy all the way up that trend, they'll sell to you. They'll sell out up there and then they'll let it flush again. And they'll do it all over. They like to do that sometimes 3 times. They'll go once, they'll go twice, it'll bring it down, they'll try to go 3 times, see how good they can do. All right. That's the name of the game. That's the coincidence. Let's go look at Amgen. We're so focused sometimes on the Magnificent Seven that we forget that there's other really good stocks out here. So what have we got going here? Again, we got down through this nice, beautiful drawdown into this big accumulation stage where they accumulate a whole bunch of shares. You can see they start accumulating here. Look at the green on the accumulation. And then they start to sell out. Sell. Get us retail traders to buy in. There's another one. There it comes in. So that's our A1 right here. This is A1. This becomes right here. This becomes B1. And there's a chance that there could be a C1. We could get a C in here. This thing's coming down right now. So it's giving a nice little pullback going into a reaccumulation stage, possibility of a third try. They may try one more time. Then they'll pop it, wait for that blue light to kind of intercept. It might come down in here, the natural trend line down in here, looks like. The blue line will come down wherever that blue line crosses. And then that's going to be where they've accumulated. See, they're accumulating right now. See that? So that's what this is. This is the accumulation. They're bringing the MACD down across the bottom here, and it'll cross that histogram 0 line. It'll turn it right here. It'll go green. Once it goes green, that'll be a good place to buy down in here. And then, boom, that market will go back up again. All right. So buy low, sell high. That's all they're doing. They're just buying low, selling high. But we're scared to do that. They got us trained real well. And look, this is BlackRock itself. Look at this. So this is drive 1, drive 2. We're down here into the Fibonacci sweet spot. Now, I got a theory. They don't like to see their own stock fall, and they know they're the ones that are driving it. So I don't know how far they'll let their own stock fall before they start beefing it up and start to run the market back up again. Because they're proud boys. They don't. I didn't mean to use it in the term that you probably expected, but they're pretty proud guys, right? Proud of their own company and their own stock, so they don't want to see their own stock fall very far. So I don't know. Do you think they'll manipulate the markets to keep their own stock back up too? So you got this drive here. So there's your ABC. We're down here. We got one more. So we got this break here. Kind of got that funny little break right there. I'm not going to count that. Hate it when that does that because then you have that screws up our count. But we're going to come in here and anticipate there's a possibility of a continuation of the downtrend, or if it just stays above this low, right? That's our turnaround point. That'd be our head and shoulders. We kind of have an ugly little head and shoulders in here. Don't really have much of a left shoulder in there. But that's kind of where that's at. A little left shoulder all the way back there. I don't think so. It's down. It should be down in here somewhere. So our little left shoulder is not very well created, but we got our neckline in here. Come on, neckline. Like that. So again, this is our head. Now, if it comes down here and breaks, this right shoulder comes down and ends up lower than the head, then we would have to grab the whole thing and move it all over here like that. But right now, we're just going to leave it right here where it's at. Right? We're going to anticipate that if this thing breaks above that neckline, well, that's where the market's going to turn and start to go up. And they're going to start to sell to us retail traders who are going to start to buy. All right. This is Bristol Myers. Look, Bristol Myers breaking new highs. So we get so focused on the Magnificent Seven sometimes we forget that there's other markets in here. These are my Lands Richie Rich Fund, my top 10. And then I have another set that says the next 10, and then the next set is the next 10. So that's 30, 10, 20, 30. And then that's the Richie Rich Fund. These are good stocks, some of the top stocks in the industry. And these stocks pay dividends. So a lot of times they're very stable. They're not big growth stocks. All right. So, but if you like stability, that's a good one. Bristol Myers. It's trying to break out, isn't it? Right in here. Look at that. It's trying to break. It's trying to go higher. So what's that? Almost like 3 times a charm. So there's charm 1, charm 2, charm 3. Let's expect this baby to rock and roll now. All right. We're gonna anticipate a rock and roll Bristol Myers. All right. Okay, so Cisco. Would you buy a call option here? I don't know if I would. It's got to be explosive to buy a call option. Let's go see if anybody else is playing with the call options in here. See, nobody's playing call options on Bristol Myers. And the reason is because it's not an explosive stock. Well, there's some in there. There's some calls in there. But look, the volume is nothing today. There's 21 of them today here. Somebody bought 21 right here. So they bought some deep in the monies. That's probably some sort of a strategy. Probably going to put that on there. And then that's going to be their that's going to be um, their call option that they're going to sell premium against. Going to probably start selling to pay for that. So how would we do that if we were going to do it? Well, we'd come in here, we'd buy this. Now they bought 20 of them. So how much money? Let's for us, we'll buy 3, $2,000. Okay, so we'll buy 3 of these. Let's just mark it in. Come on. Oh, we hit them. View, hide, unhide. Okay, there it is. So we got this one. Now what we would do is we'd come into a much shorter time frame, maybe 15 days, maybe 10 days. And maybe 10 days. And then what we would do is we'd come in here and we'd sell these. All right. So we would sell these at the money. And we'll make, now they did 20 of them. We're doing the 3 of them. We'll make $300 on this in the next 10 days. That's pretty good, right? I mean, it's not bad. So we could go a little less, a little more. If we put it right at the money, we'll make $300 in 10 days on that strategy. And then we just keep doing it over and over and over again, right? We just keep collecting the premium on this. Eventually, this will pay for this one because it's 135 days. You can do your math. How many times could we do that? So if we come in here and we say, all right, let's come in here. Let me get me down here. I'm going to blow the screen up a little. How's that? So we're going to come in here and use our calculator. And we would say, if we can make roughly $300 every 10 days, how many 10 days are there in 135 days? 135 divided by 10 equals, there's 13. So if we could do that 13 times, we're going to make 300 times 13 equals 3,900. And we paid 2,700 for the long call. And if the market keeps going up, we make 3,900 on our covereds, and we also make whatever profit on the covered calls. And if it goes down, we still at least make, even worst case scenario on this. If we just kept doing this, worst case scenario would be what, $1,000 in 135 days. That's worth doing. You know what? That's no kick in the pants. Can you see how I did that? That's why people do this strategy right here. All right. So that's $1,000. I mean, not guaranteed, but about as close to guaranteed as you can get. $1,000, because the worst case scenario, you lose the entire 2,715. Best case, and you're going to make your premium 297 every 10 days. And then if the underlying option actually does grow and make money and the market does go up, you make that money too. So, worst case scenario is $1,000 profit on that. So we'll go ahead and we'll sell those. Let's just see if it'll market into them. So that's that game. That's how you play that one. All right. So we'll come in here and Cisco, that doesn't look good, does it, for Cisco? Drive 1, drive 2, drive 3, drive 4. That's rare. Drive 5? Holy camoles. 5 drives. One big drive there. That's the 5th drive up. Drive 1, drive 2, drive 3. Almost makes you want to call this a reset because that's 3 drives. Drive 1, 2, 3, red bars. But then that's only 2 drives. Wow. Okay. Well, the coincidence on this is that we'll probably get another flush back down because that becomes X1S A1, which is 25% chance it's going to continue higher. So I'm going to expect that to flush back down. How far? Well, wow, that's a run. That's a really beautiful run. So from here to here, probably back down into this region here so that they can start doing an accumulation, get some more shares, and get everybody who's been buying all the way up here to sell out to them so they can get some more. And then they can start. They're probably out of shares. They probably sold off. They don't have any left. And so now they need to get it to come back down so that they can buy some more. And so that's probably where they'll bring it to, down in here. Does it mean they can't just say, oh, hey, I'm getting a nice accumulation right here, right? And then they say, that's enough. I'm good, right? I got all I need. I'm going to go again. And the market takes off and go again. They could do that. You know, you're getting your little signal right here from this is the little signal we like to see. But remember, this is an X1SA1. So the probabilities of that happening is pretty low. Probabilities of that happening is pretty low. Come on, let me have my tool. Go to the back. Go to the back. Extend. How do you send it back? There we go. I'm going to get this one up here. So I think we're going to get another fall on this one. I think we'll get a drop down into this region here somewhere before they start doing a more serious accumulation so that they can then start to run it sideways for a little while, and then they'll run it up from there. We'll see. Hindsight will tell us. But it's just a coincidence, right? X1SA1, this is our B1. I think we're going into a 3 times as a charm on this one too. So I'm going to get rid of all these. This is just a 3 times a charm. So charm 1 is here. This is charm 2. This is charm 3. This is our first drive. So I'm going to call that, since it's charm 3, it's XS. It's just an A1. Straight up A1 right there. I think we could look for this market to give a little bit of a pullback, break those blue lights, and make the next drive up, which would put us into a B1, right? So that would be B1. So that's Chevron. Do you like that, Lan? Yeah, I think, you know, it is what it is. You see all the little collections of a little green, a little green, a little big green. I don't know. Maybe this might be one big long accumulation stage. That's why you get that little 3 times a charm. Try to get you to buy in. Start to buy. Give them your shares so they can flush it down again. Buy, get you your shares. I don't know. We'll see if this is the run right here. If you spread it out, it looks like that. That broke the previous high. I think that's it. I think that's your A1. Let's go to Home Depot. Ooh, we were looking for this to come in here. It came all the way down here. All the way down here. So there's your X1S A1. That's your 25% chance of being the bottom. And then it turned and came back down here. This was that's our head and shoulders top formation. We were pretty good. We nailed that one, didn't we? A, B, C, D, all the way down to 130.9. That's our golden ratio. Man, that thing just like a, say it for me. Say it for me. Train on rails. It's like a train on rails. Chad makes fun of me. Every time I say it in class, he says it before I get it out of my mouth. Train on rails. Say it for me. Look at that. Man alive. You can't draw that in a book for an example any better than that Home Depot market right there. Right down to 130.9, just like a train on rails. All right, so here's our target to the upside. So let's see if it'll come back up. hit that, bounce, probably give us a little bounce. And if it stays at X2SA1, that'll be the turnaround point. All right. Otherwise, it doesn't mean it can't go to X3SA1, right? And come down and break that and create the next level down. But generally speaking, this is what we're going to see on Home Depot. Now, you could do the same thing here on Home Depot that we just did back there on Bristol Myers. If you wanted to, you could come in here and buy a long call and start selling coverage against it. You could do that. Let's see. Coca-Cola, but you'd be doing it at the X1S, you'd be doing it at the X2SA1, which is roughly 50-50 chance, right? So this is Coca-Cola. Man, a lot of these markets are really doing well. So they've turned around A1, B1. That's our spider web. That thing is ready to go. Coca-Cola. Remember, we were watching Pepsi because we were looking for Pepsi to follow Coca-Cola. Didn't do as well. This come down X3S. Look, that's a 3. Is that a 3 drive pattern down? Pretty much. X3SA1 is what we called it last time we looked at this one. This is your B1. So that's your A1, B1. It didn't break the... Oh, it double bottomed. It is what it is. And now we're having higher lows. Oh, this is Pepsi. So as long as it stays above that natural trend line, look, they're buying in here. They're buying. We got our little signal right there. Give it more room so you can see it better. There it is, red to green. Shallow. It's shallow, but it is what it is. It's just too shallow. Let's go back to Coca-Cola. Coca-Cola's got a little bit better. So there's our A1, B1. Ugh. I don't want to call that C1. Is that really a C1 on Coca-Cola? I don't know. I guess. I really want to call this A1 right here and just say this was all part of this accumulation stage. I don't know. Only hindsight will tell us what these guys are thinking. But I think this is probably all accumulation in here. And since I'm going to speculate, I'm going to call this, I'm not going to call this C1. I'm going to get rid of that. Delete that note. And I'm going to take this note and I'm going to call this B1. And I'm going to call this A1 here. You guys going to be okay with me doing that? I know it's being a little speculative here and discounting this little move in here. But I think that little move in there was still part of the accumulation stage. I think this is where they broke it right here, not back here. So they broke it right there. That's where they started to run it, start selling out all their shares. Okay, and now they go through a little bit. I think they're going through a reaccumulation through here, getting some more shares so that they can start selling them out. And they just broke it right there. And now this thing's going to run some more, and they're going to sell all the way up that big trend. All right. Pepsi doesn't really look like. I'm going to make this same call over here. We're going to delete that one. We're going to delete that one. We're going to call this the accumulation. We're going to call this the 3 times a charm. All right. This is still accumulation, in my opinion. I think we're still going through the accumulation stage. All one great big long accumulation. And this is the charm 1, charm 2. This is charm 3. So they break it, get you to buy in, take it back, break it, get you to buy in, take it back. And it's on the third one that they oftentimes will go. Now, it doesn't mean they have to go on the third. It's just that coincidences are that it goes on the third. So this is where I think we'll see this thing go. And I think it's going to start to go here. Everything's telling us that that should be a good to go. We'll have to see. I don't know. How would you play it if you wanted to play it, Lan? I like Pepsi. I want to be in Pepsi. Well, we could play it with some options, or you could just buy some shares. Just do some accumulation of your own. Let's come and look at a 170-day option, see if anybody's playing out here. Oh, look, we got some people doing this. These are at the monies. I don't see any out of the monies, in the monies. Let's go to 107. There's 16 right there. Somebody's buying some calls right there today. But they've been holding them back in here for 107 days. Let's go out to 198 days. Yeah, they've been putting them in, buying some out of the monies. Nobody's bought any of those today. Let's go 44 days. Yeah, we got a few people buying some in the monies. That's people anticipating a rise in price. I was looking for somebody who might be doing some sort of a covered call strategy in here. That's what I'd be more inclined to do. 100 days. Let's see how much that costs. How much can you get out of one of these things on a 10-day? If we just come in here, maybe 10 days, you can get $200. So if we come down here to, let's say 15 days, you get $273. $273. And let's go 170. How many could we get out of that if we just did that? $273, 170. That's, how many days was that? Oh, wait a second. We have to do it like this. Okay, 15 days. How many 15 days are there? So we would write it down. I haven't got that good a memory. So we got 15 days, right? So do your math. You got 15 days. Your calls at the money are $272, right? That's the call at the money. And then if we went out 100, let's say 170 days. Yeah, I don't really like that. There's no volume in here today on that one. Oh well, let's say that we got $1,500. $1,500, $1,500 is what we're going to have to pay for that, and it's got 170 days. So if we got 170 divided by 15, that's 11 times. So we could get 272 times 11. Well, that's easy to do. 11 times 272 equals 2,000, about $3,000. We'd have 100% markup on that. So our max loss would be, if we put that on, our max loss would be 1,500, and our max gain would be 3,000. So 1,500 would be our max loss, and our profit would be 3,000. So our lowest profit would be $1,500. So we make $1,500 over the next, right? So we could do that. You guys want to put another one of these things on? So we buy one of these, and we come in here and we buy, let's buy 3 of them. And we're going to say place order. Oh, that's a limit order. Let's just mark it in, see if they'll give it to us. Nope. There's 0 volume. Anyway, we'll probably have to play with that one. I don't know. That's a $30 spread. Oh, it just went to $85 spread. I ain't going to do that. We'd have to play with that one. I bet if we were doing real money, we could get better than that. There's 1,800, 1,900. I like the 1,500 better. $1,500. I don't know. The problem is the spread is so wide, and I'm not getting what I want out of it. 170. Let's go to 100. I have to do the math again. That one's better. I mean, 16 people have done that one for $1,000. So $1,000, how many would we get in 107 days? 107 divided by 15 days is 7. So we would get 272 times 7. So we'd get 1,900 and we'd pay $1,000. So we'd make $900. Worst case scenario, we'd make $900. That wouldn't be bad for every one. And if we did 3 of them, we'd make $3,000 over the next 107 days, roughly. That's pretty good return on money. Can't get that at Cash Valley Bank. All right. So let's come in here and look at Pfizer. Who wants to buy Pfizer? Not me. Anyway, that's Pfizer, and I'm not interested in it. All right, guys. The software I'm using is Track and Trade. And if you want the software I'm using, you can go get it over at trackandtrade.com. And of course, I want to invite you to all subscribe to Pit News Magazine, because that is where I put out all this great information. Every month we get a new magazine based on the stuff we talk about in these classes. In the last issue, the June issue, actually, we're not in June. What month are we in? April issue. April showers brings May flowers issue. So the April issue, it's a very good issue. I'd recommend you go sign up right now if you haven't done so. 50% off right now if you use the code 50% OFF. And for those of you who are in the class tonight, we will see you in class tonight. What happened? Oh, that's my book. If you want my book, Lan H. Turner on Amazon, go get my book, and it teaches you all about this stuff we're doing right here. It's all in my book, 238-page workbook, 8.5 by 11, full color. Go pick up the book, search Lan H. Turner on Amazon, and you can have the book. That's the manual to the class. But we are actually having our class tonight, and we're going to review some technical analysis stuff and day trading. So if you guys are in the class, I look forward to seeing you then tonight, 6 o'clock at the university, Udvar Hazy Building, 2nd floor, I think room 204. So come along, join us at the university if you want to come and sit in on our class and you're in the local area. Of course, you got to be in the local area. I don't know how this thing works. Okay. All right. It's a live class, and we'll see you tonight. And for those of you who would like to, we'll meet you tomorrow afternoon for day trading. And we'll do day trading tomorrow afternoon at Power Hour, 1 o'clock Mountain Standard Time. Make the adjustment for your time, and we will see you guys tomorrow. And if you like this class, if you had fun, if you learned anything, go ahead and hit that little thumbs up. That always lets me know I'm on the right track and teaching the right things. So give me a thumbs up if you think we're on the right track. And if you don't think we're on the right track, don't give me a thumbs down. Just don't give me a thumbs up. All right. We'll see you then. We'll see you tomorrow.